everyone, welcome to my channel. Today we will start our second part of our course. So, we will talk today about mastering boom and crash indexes, the basics of synthetic trading. So, we will talk today in our presentation about how and why we are trading boom and crash, and we will get involved more in technical analysis and also talk about psychology, trading psychology, and risk management in this course. So first thing, this is a disclaimer that I need to explain for everyone. Whatever course, whatever information you can find in my courses, it's for educational purposes, does not guarantee future results for anyone. CFDs are very complicated and it involves significant risk, private capital loss due to leverage. Always conduct independent research and understand the mechanics before risking capital. Means you need to understand this market very well before start trading with your own money. So that's why I conduct these courses so everyone will get the knowledge and will understand the market very well before entering the market with his real money. So, first question in this course is why we trade boom and crash indexes. What are the advantages of boom and crash indexes? First of all, they are available, as I said previously in the past course, they are available 24-hour, never stops, providing continuous global trading opportunities, 24/7 available every day, all the time. You can just enter the market and open trades, but you need to understand how and why you are opening trades. Not affected by economic data or by global events or central bank announcements or whatever, any war happen, any political issues, it's not affected. The movement will be in the same rhythm all the time, always. Clear technicals. You can analyze this market very well. The structure price, the movement, the strategy based trading, it will be very easy for you guys. And when I share the screen and the chart of woman crash, you will understand this point very well. And fast potential as well. And rapid price movements reward traders who utilize quick risk management. Again, I say risk management is the key, the main key of trading boom and crash. I'll give you some examples of the chart now. You will understand why we trade boom and crash. As you can see here, the boom means boom. You can see the big spikes upwards, right? The spikes on the upside means we are always buying boom indexes. We have, I think, yeah, for now we have four boom indexes, which are boom 1000, boom 900, boom 500, boom 300, and also they will add more indexes about boom and crash as well. So the behavior of boom, slow movement downwards. See, you can see it moves the same way and downwards. There will never be sudden movement downwards. The big movements always up. Green candles means we always buy boom indexes. That's why we always buy because the we are targeting the big moves so we can make big profits. So suddenly it moves slowly downwards, then suddenly explosive upward spike means suddenly big spike and upwards will come. That's why I say always we buy boom because we target the long spikes and we sell crash because we target the red spikes, the big spikes. You can see the opposite way of movement of boom, the crash. It moves upward in very slow way. So you can manage your money, manage your account. You can exit at any point you want. There will never be a sudden movements against you. The sudden and big movements, it's in your way. Like if you are selling a crash, the price will move very strongly down. That's why we only sell crash. That's why we only buy boom. This is the biggest advantage of boom and crash trading. So we will talk about mapping market movements. We will understand how the market move. We will go deeply into this market and explain the market structures. So always market moves in three sides or three ways. Rather be uptrend means the buyers are controlling the market, or downtrend, the sellers are controlling the market, or sideways in the horizontal between different boundaries without dominate trend. So we cannot see in sideway, there will not be uptrend or downtrend. It will be sideway. When this happens, when the buyers and sellers they are fighting together. The buyers pushing and the seller are pushing, then again the buyers moving again, the sellers moving again, because this market is all about buyers and sellers. They are controlling the market. So how I will come to know when the trend is up? When the candles, which I explained previously and I will explain today as well, it give me green colors and price made higher high and higher lows, means the price is moving up, means the buyers are controlling the market, means I can open buy positions if I understand how to analyze the market. I will explain all these details in this course. And when the price is making lower low and lower highs, means the seller they are controlling the market, means the seller pushing the price down. So that's the difference between up, means the buyers are in control and the price is going down, the sellers are in control. And it's sideways, the buyers and sellers they are in a fight and price still didn't take any movement, rather be up or down. So these three states of market structures, the only market structures you will see the chart. When you open any chart, it's rather go up, down, or sideways. That's simple. So now we will talk about support and resistance. This is the basic way of analysis. Anyone can understand it. So you need to understand this very well because this is the basic way of analyzing the market. We have the support levels, which is the floor. I call it the floor, the demand area. And we have the resistance, the ceiling, or the supply area. We have demand area, supply area, support, and resistance. What is this and how it's important? Support and resistance, they are some levels the market, when the market move, the market create some levels that it's respected by the price. Like for example, price will touch this level and bounce back, and again it will touch it again and bounce back again. So that's how we identify support and resistance level. Means the price is, if it's down, the price is supported by this level. So when it's touched again, price will bounce back. But in the resistance, when the price is reaching the resistance, rejection is happening. So the price is moving down because the sellers the sellers are controlling in this area. So whenever price will come here, it will be rejected again because the sellers still are strong in these levels. So this is the support and resistance level. Means the demand area, which the price will bounce back again and we can enter buy positions, or the resistance area, the ceiling or supply area or supply level, which the price will reach and bounce back and rejection will happen and it will come back down. We can open sell positions. So this is the simple way to explain support and resistance. How we can identify support and resistance? We have three ways, main ways of finding support and resistance level. The historical highs and lows. That's a simple way. You can see price will make highs and lows. So if the price moved up, made and high, then moved down, made and low, then again bounce back and higher than the same, we call it this double top. Again, from the same previous high, it's bounced down. It rejected to come down. Means this is a strong support level. Yeah. Then if the price is making low in this area, then again visiting the same area, the same low, and bounce back, this is a support level. All right. So this is how we identify highs and lows or supports and resistance using historical highs and lows. So we can find horizontal zones where price has previously paused or reversed multiple times. So if the price reached to same level multiple times, we can draw easily support and resistance level. Or we can use an indicator called moving average. We will explain moving average in the next slides also, not today, in the next course, so you will understand how. This moving average is drawing for me the average moving of the candle. For example, if I set moving average and I write down or I choose the 50 moving average period. What does 50 moving average period means? It will calculate me the previous 50 candles movement. It will shape it for me in one line. So this is how we can identify support and resistance. If the price touch the same line again and again, means this is a support or resistance level. We can use indicator like SMA moving average, simple moving average 50 means the line will give me the indication or the drawing of the previous 50 candles. If I choose SMA, which is simple moving average 200, then it will give me the average movement of last 200 candles. And whenever we change the number, the average will be changed and the shape of the line will be changed. This is the second way of identifying and hunting support level. Then we have the trend lines, drawing lines through sequential lows and highs that the price will respect the area. We can see its uptrend. How we understand its uptrend? The price is making trend line, upward trend line. So this is a support level. When we draw one more line here, it will be a resistance level. So this is the third way of identifying support and resistance. We have the historical highs and lows, we have the moving average, we have the trend line.